Learn the rules like a pro so you can break them like an artist. Pablo Picasso.
Are you ready to make the most of the only life you have? To make smart money choices focused on achieving what you care about most? Here to help you balance living well today without sacrificing your tomorrow is the retirement answer man, Roger Whitney.
My daughter takes after me. She does not like math. I know you're saying, Roger, wait a second. You are a financial planner and advisor. What do you mean you don't like math? Well, I can do math. It's something I do as part of my craft, but it's not like it's my passion. It's a tool for me. And I remember when she was in high school taking algebra and statistics, she would come home with some huge assignment and complain to me, Dad, why do I need to do this? I'm never going to use this in my life. I got calculators that can do that. Why do I need to learn how to do the formula? And I understood that. Back in, I think it was 2003, when I was in the middle of taking my Certified Investment Management Analyst certification, the program run by the Investment Management Consultant Association and the Wharton School of Business, after about 9 months of intense study, we go to Wharton and we spend a week working with the Wharton professors, going through the curriculum in preparation to sit for the exam. Now, not many people pass the exam on the first try, so it was, important. And then after about 8 or 9 hours in the classroom, we would break for dinner, and then they would have this math refresher session at night because there was a lot of math in the certification exam. So I would go after dinner because I needed it, where we would work through memorizing, as an example, the formula for standard deviation, memorizing the formula and practice calculating standard deviation, because we were going to have to recall the formula and do that on the exam, along with other things like the capital asset pricing model and all this geeky stuff. So I went every evening to make sure I've honed my skills and to be able to do that, and I successfully passed the exam. And I have never calculated standard deviation again. But what that process did for me, and what I explained to my daughter is, you may not ever do this again. We do have machines that can figure this stuff out. But by you having to go through it, it will give you a greater appreciation for how a measure that you may use is derived and what it's good for, how it can help you, but also, just as importantly, what it isn't good for. And you'll understand when people are misusing it or using it in a way that isn't really accurate or supporting the argument that they're making. And that's really important in life, but it's extremely important in investment management because, I'm going to tell you, my humble opinion, most advisors have never learned the rules like a pro. So oftentimes, whether it's standard deviation, asset allocation, correlations, market, all the different things that go into asset management, most advisors don't understand deeply enough. So on today's show, we are going to continue our examination of investing for and during retirement, so you hopefully can have a greater appreciation for what the rules are. My estimation are, if you've listened to every show and you've really dug into this stuff, you probably know as much as your advisor. I bet you most of them don't know a lot of this stuff as in depth as you do if you've paid attention. And now we got to talk about, okay, how do we break some of these rules to serve us in creating a great life? Now, we can't do that until we have, that all-important disclaimer. All right, it's time for that all-important disclaimer. Don't take advice from me, Roger Whitney, on this show. I only give advice to clients who I work for, and I'm assuming you're not a client. If you'd like to be a client, go to rogerwhitney.com, click on Work with Roger, and we can set up a time to talk. But until then, think of this as helpful hints and education. And before you make any decisions, talk to your legal advisor, your tax advisor, and your financial advisor. Why don't you talk all three of them? Now, remember, we're going to talk about investing in general, so we can't invest in indexes directly. Different types of investments have different levels of risk. Some may not be appropriate for you. So it's important that you do this on your own or with your advisor and not take advice from me on the show. And then there's more important disclaimers at the end of the show. Now, if asset allocation is all about math and it doesn't really work 100% for investing in retirement, why is it what everybody uses? Let's talk about that in the Hot Topic segment. Well, in the news today, we are going to talk about why is asset allocation the best practice of investment management, whether it's at a major financial firm or a do-it-yourself firm. Why is this the case? When I Google asset allocation, which I love to do just to see, how much has been written and talked about on different subjects, it's an interesting thing to do with things. If I put an asset allocation into my Chrome browser in 0.046 seconds, I get over 21 million hits. There's a lot of data and a lot that's been written about asset allocation because it is the de facto way to invest. So why is that? Especially why is that when we talk about investing for retirement? Because if you've been listening over the last few weeks, we talked about the data that goes into asset allocation, the return assumptions, the standard deviation assumption, and the correlation between assets, and how a lot of that data is not extremely robust. Some of it only goes back to the 1970s, which isn't necessarily that long in statistical terms. And then going back even farther than that, you can get data, but the quality of the data, because they weren't tracking a lot of this stuff as closely as they are today back in the 50s and the 40s and the 30s and so on. So we have a lot of incomplete data. And then that data, as incomplete as it might be, is somewhat easy to manipulate. Many asset allocation models will put a return expectation on top of the data. They'll adjust the data based on their forecasters and strategists and everything else, and that adds another layer of uncertainty to you, to the asset allocation pie chart that comes out for you. And then, even more important maybe, is that asset allocation is focused on maximizing return for a given level of risk. Well, how do you define risk? And we talked about the basic ways of growth with income, moderately conservative, things like that. And the way that the industry deals with risk in choosing what risk is appropriate for you isn't based on your life. It's based on the risk tolerance questionnaire, which asks you a series of 10 or so questions. And then in the back end, it scores those questions so it can create a pie chart, which it says is appropriate for that given level of risk. And there's lots of problems with that because the risk tolerance questionnaire, its ability to actually gauge your risk tolerance is suspect at best. And then if you premise that it is accurate, then basically what you've done is you've invested in a portfolio, if you implemented it, that is positioning you to experience the maximum amount of risk that you say you can emotionally handle, whether you need the risk or not, because it's a measure not tied to your life and the things that you want to accomplish at all. It's not tied to your retirement goals. It's tied to this questionnaire, and it's done that way because it fits nice and easy into the asset allocation model. So if there are all these shortcomings with asset allocation, why is it the norm in investment management? Well, here are my thoughts on that. First, using asset allocation, it's easy to model in programs for planning purposes. If you've watched some of my webinars, we use asset allocation in the modeling because it's easy to model. If you were to have just stuff all over the place, it would be very difficult to model to try to do all the simulations that we do in the planning process. So one, it's easy. It's easy to model in the planning purpose. Two, it makes sense. And I'm going to guess if you have been listening to the series, as we started with what can the capital markets provide and talked about dealing with risk and talked about building asset allocation, it all makes very good sense, especially when you're accumulating assets. But then when we started to unwrap it a little bit, go beyond the typical rules and look at the seasons of returns and some of the issues when you're within the withdrawal stage of life, which is retirement, we see how, well, it doesn't necessarily work all the time. But it looks great. There are lots of great charts and graphs that are easily digestible, and they all make intuitive sense. And the third reason is it's easily leveraged when an investment firm is building a business because it's easily automated. So if you are an investment firm and you're looking to grow to become the biggest in the country or scale so you can take advantage of cost savings and technology, asset allocation works pretty well. You can manage a lot of money for a lot of people very easily. And it allows the advisors to become not necessarily advisors, but to become relationship managers and simply parrot the views and research from the investment firm. And I'm not saying that in a derogatory way. I'm just saying that is the model. The model is for most investment firms and advisors is we as the investment firm will put all clients in this particular asset allocation model and produce all this research. And you, advisor, will understand the basics of it, and you will funnel relationships into the model, and then you will go have meetings and share the research that we have and talk about the softer side of things and love on your clients. That is the model of most firms, and it's been extremely successful. They've built up trillions of dollars in assets. And now that has extended to the robo-advisors and other platforms where they don't need the advisor because it's simply a software program that you answer the questionnaires, it spits out the pie chart, and it's allowed many of the robo-advisors that have been successful to raise a lot of money in a very short period of time because it's just simply a computer model. The fourth reason I think asset allocation has become the norm is it gives compliance cover to the investment firms and the advisors because it has become the de facto best practice, starting with ERISA, as we talked about back in the 1970s, and has been adopted by the planning facility. So literally, if an advisor does the risk tolerance questionnaire, implements the asset allocation, redoes the investment tolerance questionnaire, and does it consistently and does all the documentation, they're probably pretty safe from any legal blowback if markets go bad. So it's a safe way for an investment firm to manage a ton of money and lower their liability. And then lastly, I think, and it all sort of goes together, is focusing on asset allocation focuses the conversation on saving and investing, which is how investment firms are paid. I'm not saying that's bad. I'm just saying that's how the structure works. So asset allocation serves this, and I'm not going to argue that in many ways it serves investors and savers. The question is, has it led to lazy decision-making now that we're not dealing with accumulation of assets, which I think asset allocation works extremely well for, but we're now starting to deal with the decumulation of assets, which is retirement. We're starting to see that asset allocation may not be the entire answer. That doesn't mean we throw it out. And we'll talk about that in our practical planning segment. Hey, welcome to the practical planning segment. Now, we are continuing this long journey on building a solid foundation for making hopefully better investment decisions so you can have the life that you want in retirement. So I think the fundamental issue here is we need to have a investment strategy that is tied to the goals that you want to achieve during your retirement or this decumulation stage. Now, just a second ago, I beat up a lot on asset allocation. that doesn't mean that it is not a very sound, academically rigorous framework for making investment decisions. I think it is, but I just don't think it's the entire solution when we're dealing with the retirement problem. So if it's not the entire solution, what is? Just asking that makes me laugh because I have no clue what is the whole solution. So what I'm going to do is share with you my thoughts and how I implement portfolios with clients as they're entering and in retirement. Now, I'm not saying this is the whole solution. I'm not saying it's perfect. I'm not saying that it won't be adjusted in the future. But I just am going to share with you where I've come to after 25 years of learning the rules in depth and then applying my accumulated, hopefully, knowledge and wisdom to help it work for clients. Now, a lot of it is wrapped around the agile retirement management process, which is lots of quick conversations. But we're just talking about investment management only here today. So that's where I want to focus. So the way that I have come to manage assets with clients is what I call fixed and flexible. So let me explain a little bit what my fixed and flexible approach looks like in allocating clients' assets. Now, it's in no way perfect. It is a work in progress, like everything in life, right? But it's based off of all of the knowledge and wisdom I've accumulated and hopefully learned from. So it starts off with a fixed allocation as the foundation. And this is a fixed asset allocation foundation. So about 40 to 60% of client assets typically go into this type of allocation, which is trying to basically get in the middle of the capital markets. Now, in an episode, a year and a half ago or so, I talked about the capital markets, which are investing in the world economy, whether it's real estate or equities or in bonds or some other flavor of those major asset classes, how the world economy and in the investing world is like a river. And the river has a natural current to it, which is generally growth, right? The economies generally grow. The world economy generally grows with every now and then, like every river and every economy, you hit rapids. You hit sometimes really small rapids or really big, nasty rapids, which in investing are corrections. In the economy is a recession of some sort. And when you're setting a fixed asset allocation, whether your mix of stocks, bonds, and real estate or whatever flavor you have of those asset classes, you are basically determining where in the river you want to be. So do you want to be in the fastest part of the river where the most growth potential is, which likely will lead you to hitting the rapids head on? Or do you want to be near the slow part of the river where the current is almost undetectable, but you don't move along that quickly, but generally you stay dry when the rapids come? Choosing your asset allocation, your mix of stocks, bonds, and real estate and such, is really choosing where you want to be on that river. So I do this as the fixed part of a client allocation. And the reason is it's a great framework for managing the risk-reward trade-offs of investing. And it has some major advantages. Number one is if you're using something that mimics an index or some other model that gives you broad diversification, generally those are very low in expenses. This is the attraction of them, one of the primary attractions for many, in that the expenses are very low, which means that goes right into your pocket. Number two is they have very low turnover, meaning they don't trade a lot typically, which reduces costs further because when a mutual fund or an ETF trades, there's a cost involved. So low turnover can reduce that, and it can help to minimize taxes as well. And then lastly, they're very transparent. If you buy something that mimics the S&P 500, as an example, you'll know pretty much everything it owns. You can look it up, and it's pretty clear. Now, some of the disadvantages or challenges to this fixed allocation are that, well, if you choose a spot in the stream or the river in that fixed allocation and the rapids come, if you're going to stick true to the philosophy, you're going to get wet. And you're going to get wet dependent upon where you decide to run that river. and you will stay in that spot even as the rapids come, because that's part of the buy-in to doing an asset allocation or fixed allocation policy. One of the second disadvantages or challenges is that using traditional indexes, and we'll get into this in much more detail in an upcoming episode, is that you're sort of a momentum investor because of how indexes are created. Generally, the largest companies in an index have the greatest influence on the performance of the index. So if you're invested in something that mimics the S&P 500, at times you could have 10 or 15 companies of the 500 companies pretty much account for all of the returns. And as they get bigger, they have more and more influence. And that can be a bit scary and cause, sometimes more dramatic downturns on the downside. And then one of the other disadvantages or challenges is that we're all long-term investors until we feel short-term pain. Many of us, advisors and individual investors, are all for asset allocation when it's working, but when they go through rough times, which is part of the price of admission, it can be challenging to maintain the strategy and stay in your part of the river. Now, I've done a lot of rafting in my life, and when you're in the midst of it or you get thrown from the boat, you're supposed to swim back to the boat as quickly as possible. A lot of times you just want to swim to the shore. You want to kiss the mud. In 2008, I think many people would have been happy to swim to shore and just kiss the mud and be happy that they're not getting wet anymore. So that's one of the challenges of a fixed asset allocation. But I use it for about 40 to 60% of a client allocation. And I do it in, I think, a fairly smart way, and we can talk about that in a future episode. But that science of asset allocation only goes so far, as we've talked about. And that's where the fixed portion of the portfolios that I generally build for clients come into play. This is a flexible portfolio. So the best way to define what flexible is first to tell you what flexible is not. So when we talk about flexible portfolios, we're basically talking about actively managed investment vehicles, whether it's an ETF or a mutual fund generally or some other vehicle. Now, the vast majority of quote-unquote active managed investments are what are called relative performers or relative investments. This is not flexible. So what do I mean by relative performers? So the majority of actively managed mutual funds focused almost exclusively on better security selection within an asset allocation. So let's say rather than use the S&P 500 index for your large company allocation, you decide to hire a manager, whether it's a mutual fund or whatever vehicle, and they will buy equities that are within the S&P 500 index. That will be their benchmark, which they compare themselves to. And you're hiring them to buy better stocks rather than some unmanaged index. That's what you're buying them for. So if you are buying a relative performer, which are the majority of mutual funds are, here's what you're going to get. Their goal is not to make you money. That seems sort of weird, doesn't it? Their goal is not to make you money. Their goal is to beat the index that they are comparing themselves against, the S&P 500 index in this example. So they will typically always be invested, or mostly invested, because they're not paid to make bets on markets going up and down. They're just paid to beat their index by picking better securities, in this case, the S&P 500 index. So they're always going to be invested for the most part, absent, some cash reserves that every fund will have. Even more than that, their ability to buy better securities is oftentimes, many times, limited even further. So what do I mean by that? So let's talk about the S&P 500 index as an example. If you're buying an actively managed fund that is a relative performer trying to beat the S&P 500 index, in many cases, and almost all cases in my experience, they not only are always invested, but they will tie themselves to the sectors that make up the index. So what do I mean by that? So the S&P 500 index has different percentages in different major sectors of the U.S. economy. So about 20, I'm going to round some numbers here, but about 23% of the S&P 500 as of June is in information technology companies. That's the largest sector. Healthcare is about 14.5% of the S&P 500. Financials are about 14%. And then you go on down to telecommunications is only 2% of the S&P 500 index. So the S&P 500 index has these different sectors in certain percentages. So what oftentimes you'll see actively managed mutual funds do is they will be relative performers to the benchmark that they're trying to beat. In our example, the S&P 500 index. But even more than that, let's say they are picking securities and they don't like information technology companies, which is 23% of the S&P 500. Oftentimes, by mandate, they have to be within a certain range of each individual sector. So if the information technology sector is 23% of the index and a manager doesn't like that sector, can't find any companies he or she wants to own in that sector, he'll probably still have to own, say, 20% of the sector. So a big bet against information technology is underweighting it from 23% to 20%, or whatever the tolerances are that the prospectus give the manager to be able to make big bets. That is not flexible management. And that is the majority of what actively managed mutual funds do. They focus only on security selection. They compare themselves to their particular benchmark. It could be the S&P 500 index for large cap companies. It could be the Russell 3000 for small cap companies. It could be the Russell 1000 growth for growth companies, large growth companies. All of them will have an index that they're tied to in some ways, and oftentimes they're shackled to, even in terms of how they can express their opinions on investment selection of the markets. That is not flexible. So when I allocate a flexible approach, here's what I mean by flexible. They have a clear mandate, meaning they do have a benchmark that they compare themselves to, but unlike having an inch of rope to be able to express their views, they're given, depending on the strategy, much more rope to lean totally away from sectors that they don't like or towards sectors that they do like. And that rope is defined by the prospectus, and that's part of the due diligence process. They're compared to a benchmark, but they're not tied to it. Their ultimate goal is to achieve their objective, not simply to beat a sector of the market. And generally, they're focused on a particular type of objective like income, throwing off lots of income, or growth or protection of capital. And some strategies have the ability to go to stocks, to bonds, to real estate, to cash, within certain guidelines that are much more liberal than traditional managers. Now, some of the advantages of these types of strategies are they have the potential to lean towards undervalued assets, buy things cheaply that they feel are cheap, and they have the ability to move away from overvalued assets, meaning to not buy something if they don't like it. And there are many that if they don't like information technology, they don't have to own any of that particular sector, depending on the strategy. And they have the flexibility to build cash if they don't find anything of adequate value to buy. Now, that can be an advantage, right? And they have the advantage of avoiding sectors entirely. They have more opportunity of adding value to help move you towards your goal, potentially. Now, there are disadvantages, right? So the disadvantages or challenges are, and this is always the case with active managers, is, well, what if they don't execute well? What if they aren't able to give the meat of the promise that they give you on the front end? That's a very big risk. That's one reason why you don't want to have all of your assets in these type of flexible managers. Another challenge is the due diligence is more important and more difficult because you are looking to identify skill, not luck. And that is much more difficult, some would say impossible, than ever before. They typically can cost more than a passive type of investment because you got to pay people, the researchers and managers and all the rest. And then another disadvantage or challenge is that there could be periods of underperformance that are perfectly within the realm of reasonability, if that's a word, that can be challenging. If markets run high and a particular manager says these things are overvalued, he may be right, but he may be early, which means if he's early, he will underperform for a period of time as things continue to go up as he gets more conservative, or vice versa. So there can be some challenging times. So it's very important that you know what you own and you have confidence in the due diligence of what they're doing. Another disadvantage or challenge can be there's less transparency. There's less ability to understand exactly what's in it on a day-by-day basis, and that's a challenge for some. And then lastly, they can be very difficult to model. If they're not in a fixed asset allocation, then you can't really plug it into a Monte Carlo scenario or some other type of calculator because it doesn't account for that. And that's one of the easy parts of asset allocation. Now, am I saying that this is perfect? No, it's not perfect. But I do think it takes advantage of the science and the academic rigor that is around asset allocation and couples it with some of the art of the fact that we experience different types of seasons in markets, and we have to be more concerned about achieving our life goals than being right in a very long-term perspective from an asset allocation standpoint. And in the decumulation stage of life, retirement, it becomes much more about generating income, protecting capital from major downturns in the market, and giving a smoother ride, which can help assist in preserving and growing assets to be able to maintain the standard of living that many of us want to have in retirement. And if you couple that art with the science, along with agile retirement management, which is very flexible and constantly reiterating and challenging assumptions, I think it gets us a long way there of really focusing on not just accumulating assets, but creating a great life. Now, next week, what we're going to do is we're going to talk a little bit about the due diligence process of selecting actual investment strategies, whether they are tied, passive-like strategies that are tied to an index in that fixed bucket, or whether they are some of these flexible mandates that we're talking about today. We're going to talk about some of the due diligence that needs to be done when you are allocating your money. But that's to next week. I think we geeked out enough for today, so let's get to the Smart Sprint segment.
On your marks, get set.
Hey, welcome to the Smart Sprint segment, where we set a 7-day goal to take a little baby step towards creating a great retirement, and in this case, investing wisely for your retirement. So we've been focused on smart sprints related to this investment management approach that we've been unwrapping over, probably 5-6 weeks now. So we're going to continue with that. And what I'd like you to do, since you've been organizing all this stuff, is in the next 7 days, look at each of your managers, ETFs, mutual funds, whatever it is you own, and identify what type of investment mandate they have. Are they passive, related to an index? Are they relative active managers that are shackled to a particular index, or are they flexible managers? Understand what they are and start to think about, why do I have these different types in these different portions? And how does that relate to what I'm trying to achieve for my family? With that, let's move on to getting happy. Hey, welcome to the Happy Lab, where we noodle on being happy. I want to use this time to share a little love to a good friend of mine, Scott and Jeannine Fitzgerald. They have created some pretty cool children's books. So if you have children or grandchildren, this might be something you're interested in. It's Buddy Pegs, and it's a children's book that empowers kids to succeed through inspiration of bicycles. So they use bicycles as a metaphor. Scott and Jeannine used to own a bicycle shop. They use that metaphor in a really fun way to teach life lessons that can help our kids or our grandkids be better people. So they have a book out. They have a podcast out called Buddy Pegs, and they are doing a Kickstarter for their new book, Buddy Pegs Taking the Lead. So I'm going to share that link in 6 Shot Saturday. And why does this make me happy? Because 1, I love bicycles. 2, I love Scott, and I love what he's doing to help teach good lessons to young kids. And Lord knows they need it like every generation. So if you're interested in that, check it out. It's Buddy Pegs Taking the Lead. You can find it on Kickstarter or in 6 Shot Saturday. And go spread the love. All right, we are finished. Take your geek hat off. These can be tiring, either because they're too complicated or there are so many little rabbit holes that we can go down that I'm really trying to avoid so we can get the big picture so we can start investing more successfully for retirement. Hopefully that you're finding this helpful. Email me at roger@wwkwealth.com with any of your questions related to this episode, because we're going to start ramping up the listener questions after this series is done. Next week, we're going to talk about how to choose investment managers wisely, or start to build a framework to do that. And that should end this series. So I'm excited to get your questions and talk about them and share them on the show. Until next week, this is Roger Whitney, the Retirement Answer Man.
We appreciate you joining us today for this episode of Retirement Answer Man. Be sure to visit rogerwhitney.com/answers to access the Retirement Answer Library with over 30 checklists to help you make the most of the only life you have. Remember, you have more power than you realize to create an amazing life starting today with Retirement Answer Man. The opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and no guarantee of future results. All indices are unmanaged and may not be invested into directly. Have a wonderful day.